Hi, Claire here from Pitt News Magazine. And wow, today's episode is a ride. Mr. Turner just dropped a white paper that's part Wyckoff Theory, part crystal ball, and Jake and Lena are here to help us unpack it. We're not just talking about the idea of accumulation and distribution. We're applying it to what the three biggest market movers, BlackRock, Vanguard, and State Street, are buying and selling right now. This is the kind of inside look that makes you stop guessing and start seeing the market the way the giants do. Because if you can spot what they're scooping up and what they're quietly unloading, you're already ahead of 90% of retail traders. Oh, and a quick note before we dive in. If you want to track your own stock, investments, dividends, and distributions the way I do, check out Portfolio Matrix at portfoliomatrix.com. It's where I keep everything organized. It's brand new, and the Founders Edition is open right now. Go subscribe today. You'll never regret it. So buckle up, because by the end of this one, you'll know what's hot, what's not, and maybe even why your favorite stock suddenly feels like it's ghosting you.
Do you ever find yourself staring at market charts feeling like there's a secret language you just don't get? Or, that forces far beyond your control are pulling all the strings? Well, you're definitely not alone. Retail traders often feel completely outmatched by the giants. But here's where it gets really interesting. What if there was a way to decode what these market behemoths are doing, to actually see their footprints before they become obvious trends? That's exactly what we're going to unpack in this deep dive. Today, we're diving into the century-old wisdom of Wyckoff Theory and how it lines up perfectly with the actions of today's biggest asset managers. BlackRock, Vanguard, State Street, these firms manage trillions. We'll be digging into their recent Q2 2025 investment filings. Those are the 13F, the public disclosures to uncover their accumulation and distribution patterns. Our mission: to give you a shortcut, to understanding how these titans move trillions, and importantly, how you might be able to trade alongside them.
And what's really fascinating here is that feeling of being outmatched. It's often not just a feeling. It's pretty much the cold, hard reality. These three firms alone control just staggering amounts of capital. And their activities, well, they genuinely influence long-term market trends. They don't just move with the market. Often they're the market movers.
Right. They make the waves.
Exactly. So this brings up a really important question for us. How do we, as individual investors, get any insight into these huge movements? And the answer, or at least a big part of it, lies in understanding patterns that have been around for over 100 years, actually, codified in Richard D. Wyckoff's method. He introduced this idea of the composite operator.
The composite operator sounds intriguing.
It's a brilliant metaphor, really. It represents the collective actions of the big institutional players, and it lines up perfectly with these modern megafunds. We'll explore how their quarterly 13F filings give us that crucial window, letting us see these classic Wyckoff patterns unfolding almost in real time.
Okay, let's unpack this Wyckoff theory then. What are these core market cycles? These key tactical concepts that help us understand the composite operator's playbook. It sounds a bit complex, maybe, but you're saying it's practical.
Oh, very practical once you grasp the basics. Wyckoff's method outlines 4 distinct phases in a market cycle, and they're driven precisely by these large institutions. Think of it like the market's breathing pattern, or maybe the 4 seasons of a stock's life.
Okay, I like that analogy, seasons.
Right. So first there's accumulation. This is where the institutions are quietly buying shares, usually after a decline. Prices are often discounted. They try to keep the price within a relatively tight range while they're doing this buying.
So low-key buying, building a position without alerting everyone.
Exactly. Imagine them building a huge position slowly, scooping up shares while sentiment might be negative or just, indifferent.
Got it. Phase 1, accumulation. What's next?
Then comes the markup phase. Once they've built those positions, the price starts to break out of that range. Often you'll see this fueled by positive news, maybe good media coverage starts appearing, drawing in public interest, and you'll typically see significant volume spikes.
So this is when the trend becomes obvious. The price starts climbing properly.
Precisely. This is where the stock genuinely starts its sustained climb. The institutions are now letting it run or even helping it along.
Okay, accumulation, then markup. What happens at the top?
Well, after a significant rally, we enter distribution. This is the flip side of accumulation. Here, the institutions start to sell their shares, but strategically. They offload them into the strength they helped create.
Selling to the latecomers?
Yeah.
The retail crowd just catching on?
Often, yes. They sell to people who are now excited about the hot stock. It's a subtle unloading process. Sometimes the price might even nudge higher, but maybe with less conviction, less volume behind it.
Sneaky. Okay, so they're getting out while the getting's good.
That's the idea. And finally, without that institutional buying support, sometimes with active selling pressure, the price drops. That's the markdown phase, and that starts the whole cycle over again. Accumulation can begin anew after the markdown.
Accumulation, markup, distribution, markdown. The 4 seasons. Makes sense. But you also mentioned specific tactics within these phases, like signals.
Yes, exactly.
Yeah.
Wyckoff identified key tactical concepts, little footprints that signal institutional moves. There's the spring, for example. This is a false breakdown below support level.
A fake out move.
Pretty much. It's designed to shake out weak hands, scare individual investors into selling right before the real rally begins. They think the price is collapsing, so they sell.
And the institutions scoop up those shares cheap.
That's often the play. Then there's the inverse, an upthrust after distribution, UTAD. This is a false breakout above a resistance level. It traps the breakout buyers, people jumping in, thinking it's going higher.
Right before it falls. Ouch.
Yeah, exactly. It sucks in buyers just before the markdown phase really takes hold.
Okay, springs and upthrusts. Tricky stuff. Any positive signals?
Definitely a sign of strength, SOS. This is a strong breakout, usually from a trading range, and crucially, it comes with significant volume. It signals that powerful institutional hands are clearly in control and ready to push prices higher. It confirms the markup phase is likely underway or starting.
So strong move, lots of volume. That's a good sign.
Generally, yes. And lastly, there's the last point of support, LPS. This is often a final, maybe quick dip or test of demand that happens after a sign of strength, but before the main markup phase really accelerates. It basically confirms that demand is strong enough to absorb any leftover selling and support the upcoming rally, like a final check before launching.
Wow. Okay, that's a really solid framework. Springs, UTEDs, SOS, LPS, within the 4 main phases. Now, let's see this in action. Let's connect it to the real world with the Q2 2025 data. We're not just looking at numbers. We're using this Wyckoff lens. Let's start with BlackRock, a true titan. What, $5.2 trillion in holdings? Mind-boggling. What signals are they sending? How does it fit the playbook?
Right. BlackRock's Q2 filings show really clear evidence of both accumulation and distribution across different sectors. It lines up quite nicely with Wyckoff's ideas. So on the accumulation side, they significantly increased holdings in, get this, 2,144 stocks, and they started 265 brand new positions.
Wow. Okay. Any standouts?
Oh yeah, some really notable increases. Take GE Vernova, GEV. They showed, it's a staggering, plus 419,758% change in shares.
Wait, 400,000%? Is that a typo?
No, not a typo. It means they started from a tiny position, but the dollar value added was over $3.1 billion.
Okay, the dollar amount is key. $3.1 billion is serious capital.
Absolutely. And that kind of aggressive move, especially in a potentially de-risked spinoff like GEV, screams accumulation. It suggests systematic position building, likely after a decline or during consolidation before a potential markup.
The composite operator quietly soaking up supply. Okay, what else?
Chipotle, CMG. A significant plus 5,047% change, adding $6.9 billion. Again, a huge dollar amount. This strong increase in a well-known growth company also points to accumulation, or maybe even a sign of strength if it was breaking out, confirming their conviction. It's like they're saying, we're betting on the next leg up here.
Right, and the big one everyone talks about.
NVIDIA, a substantial plus 906% increase. That represents a massive $228 billion in value added to their already huge position.
$228 billion added.
Yeah.
It's just staggering.
It really is, and piling into an already strong stock like this, that acts as a powerful sign of strength. SOS. It suggests the best players think the push isn't over, reinforcing that markup phase.
But hold on a sec. That GE Vernova number, the 419,000%, is that always straightforward Wyckoff accumulation? Couldn't just be, they had almost nothing before and now they have something? Maybe not a full-blown accumulation play someone should just copy?
That's an excellent, really crucial question, and you're right to be cautious. The percentage itself can be misleading if the base is tiny, but the key, as you noted, is the dollar value.
Yeah.
Over $3.1 billion deployed. That's not pocket change, even for BlackRock. That level of capital allocation, especially if you combine it with looking at the chart, maybe seeing a consolidation period or a base after a fall, that's what really aligns it with Wyckoff's accumulation. It's not just adding a few shares randomly. It signifies real institutional intent. The composite operator is making a move.
Okay, that clarifies it. The dollar amount shows the conviction. So that's accumulation. What about the other side? Where were they distributing, selling off?
Right. Conversely, BlackRock also showed distribution. They reduced holdings in 2,649 stocks.
More sales than buys. Interesting. Any big names there?
Key reductions included Supermicrocomputer, SMCI, a netical 25% cut in shares. They still hold $3.3 billion worth, so it's not an exit, but
But a 25% reduction is significant. They could be early distribution?
it could be interpreted that way, yeah. If this selling happened while the stock was maybe hitting new highs but with less momentum or showing signs of a false breakout on the charts, that's a classic upthrust after distribution UTAD pattern. The composite operator is starting to offload shares to those eager latecomers.
Okay. Any others?
TransDigm Group, TDG, a negative 12% reduction, still valued at $5.0 billion. This suggests maybe a strategic shift, moving away from certain industrials perhaps. While it's not a complete exit, trimming like this over time signals a gradual distribution phase for BlackRock. Selling into strength, maybe, or just rebalancing.
So it's not always about dumping everything at once.
Yeah.
It's that systematic reduction, the process of distribution.
Absolutely. Wyckoff really emphasized the process. These giants, they can't just hit sell on billions of dollars without crashing the price. They have to distribute slowly, strategically, often when everyone else is feeling euphoric about the stock.
Makes sense. Now, you mentioned BlackRock has a unique strategy with Bitcoin.
Yes, this is quite interesting. Their spot Bitcoin ETF, IBIT, looks like it's in a full accumulation mode, Wyckoff style. They added 8,000 Bitcoin in Q2. And just recently, on September 3rd, they bought another $290 million worth. And get this, they apparently sold $151 million worth of Ethereum to help fund these Bitcoin buys.
Whoa, swapping Ether for Bitcoin on that scale. That's a statement.
It certainly seems like it. Their total Bitcoin-related holdings are now over $5.4 billion. IBIT's assets under management are huge, $86.77 billion, and saw $2.4 billion in inflows in just 1 week recently. And what's really key here, they are not buying BTO, the ProShares Bitcoin Strategy ETF.
Why not BT?
Well, likely because BTO is futures-based. It doesn't hold actual Bitcoin. BlackRock seems to be staking their claim directly on the spot market with IBIT. That's where their accumulation is focused.
Fascinating. A clear preference for holding the actual asset. Okay, let's shift gears. Vanguard. Known for being more, maybe methodical, almost passive sometimes, but even bigger, $6.18 trillion portfolio. What does their Q2 filing tell us through this Wyckoff lens? Is their composite operator playing the same game?
Vanguard, yeah, often seen as more conservative, maybe just tracking indexes, but they still made some very impactful, deliberate moves in Q2 that definitely echo Wyckoffian principles. They added to 2,427 existing stock positions.
They're still active. What were their big accumulation plays?
Their top accumulation buys included O'Reilly Automotive, RLI, a massive plus 1,404% increase, adding $7.1 billion.
Another huge percentage in dollar amount, similar to BlackRock's GEV move.
Exactly. It suggests Vanguard saw a compelling accumulation opportunity, probably after some consolidation or a dip, building a big position in a resilient sector like auto parts. Also, Capital One Financial, COF, a plus 74% increase, adding a very significant $12 billion. That's substantial, shows strong accumulation in financials, suggests they might foresee a markup phase for that sector or just see deep value there.
And any crypto-related plays from Vanguard.
Yes, interestingly, they significantly increased their stake in Coinbase, COIN, by plus 25%. That position is now valued at $8.5 billion.
Okay, so buying the exchange while BlackRock buys the Bitcoin directly, a different approach, but still a bullish signal.
Absolutely. It's a powerful sign of strength from Vanguard regarding the crypto infrastructure space. Shows conviction, aligning directionally with BlackRock's Bitcoin accumulation. And overall, Vanguard showed a strong tilt towards big tech. They increased positions in NVIDIA, Microsoft, Apple, Amazon, Meta.
Just buying the leaders.
Pretty much. This widespread, consistent buying across the tech giants, that really reinforces the sign of strength signal coming from the composite operator collectively. Everyone's piling in.
And what about their distribution? Did Vanguard trim positions similarly?
Indeed. On the distribution side, Vanguard exited 110 stocks completely, and they reduced holdings in others.
Any notable reductions?
Key ones included Amphenol, APH, a negative 9% reduction. Now, they still hold a massive $14 billion, but...
But trimming 9% is such a huge position isn't random.
Exactly. It's a subtle but clear signal of potential distribution. When a giant like Vanguard trims, especially a large holding, it's often calculated. Maybe they sense a topping pattern, maybe reallocating capital. It hints the stock might be entering a distribution phase. Also, MicroStrategy, MSTR, also a negative 9% reduction. They still have $7.5 billion remaining.
Interesting, MicroStrategy being so tied to Bitcoin.
Right. So while they still hold a lot, trimming MSTR could imply some measured distribution as its price ran up. Or maybe it's just strategic rebalancing of their crypto exposure, distinct from BlackRock's direct spot accumulation via IBI.
Showing that measured strategic trimming rather than sudden dumps fits the institutional distribution profile.
Precisely. It's methodical.
Okay, two titans down. We're definitely seeing these Wyckoff patterns emerge. What about the third giant, State Street? Their portfolio is around $2.59 trillion. How does their positioning align or diverge? Where's their composite operator focusing?
State Street Global Advisors, $2.59 trillion across about 4,260 holdings. They also showed clear patterns, often echoing the other two, which really highlights that collective institutional pulse. Their accumulation focus included significant increases in Amazon, AMTN, United Health Group, UNH, and NVIDIA, NVDA.
So hitting those same big themes, tech and healthcare.
Strongly aligning, yes. This overlapping accumulation across multiple mega funds is a really powerful indicator. It's a collective accumulation and a strong sign of strength. When multiple composite operators are buying the same names, that's a signal worth noting. They also showed a sector tilt towards global infrastructure saw a 10% gain there. And they increased their overall equity allocation slightly by 0.7% in June.
So a broader thematic bet on infrastructure too. Macro accumulation.
Seems like it, anticipating a future markup in those areas.
And their distribution. Any common exits or unique ones?
For their distribution focus, State Street reported reductions in Canadian Pacific, CP, Alibaba, BIA, and DoorDash, DAsh.
Okay. Rail, Chinese tech, food delivery.
Yeah, these reductions suggest maybe distribution away from certain cyclical areas, or perhaps politically sensitive ones like Alibaba, or maybe some of the pandemic-era growth names like DoorDash. Reallocating towards the tech and healthcare they're accumulating. Their overall risk appetite index was plus 0.36, suggesting a mildly bullish stance, which fits with that selective accumulation in healthcare and tech.
So while the specific stocks might differ slightly, the broad themes accumulate tech and healthcare. Maybe trim cyclicals seem consistent across the big three.
That's a good summary, yes. Thematic alignment is quite strong.
Okay, we touched on BlackRock's IBIC and their preference for spot Bitcoin. Let's circle back to BIDO, the ProShares Futures ETF. How does that fit the institutional picture, especially being futures-based? Are we seeing Wyckoff patterns there, or is it different?
This is a really important distinction, especially for anyone watching crypto through this institutional lens. BIDO is fundamentally different from IBIT. It's futures-based. It holds CME Bitcoin futures contracts. That's the Chicago Mercantile Exchange, a major derivatives market. It doesn't hold actual Bitcoin.
So exposure to the price, but not ownership of the asset itself.
Exactly. Now, BIDO has seen considerable net inflows recently, over $500 million in the last 90 days.
So there's demand for Bitcoin exposure, even futures-based.
Definitely. It shows strong public or maybe faster money interest. It holds about 4,700 CME Bitcoin contracts expiring in September 2025, mostly futures exposure with some cash. But crucially, BIDO isn't accumulating Bitcoin like IBIT is. ProShares, the fund manager, just adjusts its futures holdings based on investor flows into the ETF.
Ah, so the inflows mean investors are buying the ETF, not necessarily that ProShares itself is making a long-term accumulation bet in the Wyckoff sense.
Precisely. While there are inflows showing demand, there are no signs of distribution or net selling of the futures positions by the fund itself. They're just meeting demand. From a Wyckoff perspective, the lack of big institutional spot accumulation via BTO by players like BlackRock is telling. It signals their preference for direct asset ownership for their main accumulation phase.
So the real composite operator accumulation in Bitcoin seems to be happening in the spot market through vehicles like IBIT. That makes sense.
It seems that way, yes.
Okay, so we've looked at these massive institutions, BlackRock, Vanguard, State Street in action, accumulating, distributing, moving trillions. It really does feel like watching Wyckoff's composite operator at work. What does this all boil down to for you, the listener, the retail trader, trying to navigate these waters more effectively? What are the actionable strategies here? How can someone potentially trade alongside these giants, not against them?
Well, the evidence we've looked at today seems pretty clear. These institutional investors, our composite operators, genuinely seem to operate on the Wyckoff playbook, consciously or not. And retail traders can absolutely benefit by understanding this and following their footprints. It's about shifting from being reactive to proactive.
So how do you do that? What are the concrete steps?
Okay, Here are some clear strategies you could employ. First, dollar cost averaging, DCA, with intent. Don't just buy randomly every month. Try to time your DCA during identified accumulation phases. How? Combine the fundamental data study, those 13F filings like we did. See who's buying what heavily with technical confirmation on the charts. Look for that tight range after a decline where a tighten is loading up.
So use the 13Fs to find candidates, then use Wyckoff charts to time the entry.
Exactly. Second, track those 13F filings religiously. This is your direct window. Look for overlapping buys across BlackRock, Vanguard, State Street. When multiple titans are buying the same stock, like NVIDIA, Amazon in our examples, that's a powerful sign of strength. High conviction from the composite operator. And conversely, look for consistent reductions across the firms as a potential distribution signal.
Okay, track the filings, look for consensus. What else?
Third, combine Wyckoff phases with technicals. Use your charting tools to spot those key concepts we discussed. Look for springs that shake out weak hands before a rally. Look for signs of strength, SOS, those strong volume breakouts, or a last point of support, LPS, confirming demand. On the flip side, identify potential upthrusts after distribution, UTAD, or clear distribution ranges by watching price action, volume, maybe momentum indicators like RSI or MESCD. These tools help confirm what the 13Fs might be hinting at.
Use the charts to validate the institutional flow. Makes sense.
Fourth, sell into strength, not just into fear. Recognize that distribution phases often follow those big euphoric rallies. Use the 13F islands showing institutional exits or reductions as early warning signs. If the composite operator is starting to sell, you should be asking why and thinking about your own exit strategy before the markdown phase really kicks in. Don't wait for the crash.
Be proactive about taking profits when the big guys might be.
Right. And finally, fifth, stay educated and adapt. The market's always changing. The more you learn about how these big players operate, how these patterns work, the better equipped you are. Resources like Pitt News Magazine, maybe some YouTube channels like Trade Miners, or classic books like Landturner's The Fibonacci Effect, which touches on market structure, they can offer deeper insights. Keep learning.
Continuous learning is key. Okay, that's a great set of actionable strategies. This deep dive really does highlight how understanding the behavior of these market titans, BlackRock, Vanguard, State Street, it's almost like getting a cheat sheet to the market cycles. They really are the living embodiment of that composite operator Wyckoff talked about a century ago. And it's not just about reacting to news headlines. It's about proactively understanding the currents they create, the currents that shape the market trends we all trade in. So wrapping up, what does this all mean for you, the listener? How can you turn this insight into an edge?
Well, the knowledge we've walked through today hopefully allows you to shift your mindset from being just a reactive participant, maybe feeling pushed around by the market, to being a more proactive observer and potentially a more strategic trader. The real key lies in learning to recognize those signs of accumulation before a stock enters its big markup phase. And, just as critically, spotting the signs of distribution before the painful markdown begins. That timing is where the edge comes from.
Getting in before the crowd and out before the crowd rushes for the exits.
That's the ideal, yes. So maybe a key question that comes out of all this for you to consider is, how will you start applying this? How will you use this insight to not just react to the noise, but to actually try and anticipate the moves of the biggest players? And by doing that, get a better feel for the true pulse of the market. Will you start digging into those 13F filings yourself? Will you look for these Wyckoff patterns on your charts more deliberately? Learn the game, study the filings, watch the charts, and most importantly, trade smart.
And that's a wrap on our deep dive into Wyckoff Theory, applied to the real moves of the market's biggest power players. Thanks to Jake and Lena for breaking down Mr. Turner's white paper and for helping us translate all that institutional jargon into something we can actually use. Here's the takeaway. The big three aren't just moving money, they're moving the market. And now you know exactly what they're buying into, what they're bailing on, and how to spot the cycle before it spins you. If you want more insights like this, go subscribe to Pitt News Magazine at pittnews.com, because this is where we track the real market movers. And while you're at it, check out Pitt News on Air, my new weekly podcast where Jake, Lena, and I turn these big trading lessons into stories you'll actually remember. Until next time, trade smart, stay curious, and remember, if BlackRock leaves footprints, we're going to follow them.